Hello and good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. Markets seem to be in a long drawn lull with asset classes in a broad consolidation holding pattern, while this is not true for cryptos, which continuously get battered by the failure of major exchanges. Currently, the broad narratives that are running in the market is that inflation is cooling, which resulted in a rally of risk assets and weakness in dollar. Whether inflation is really cooling or not is a topic for debate, and the PC numbers due next week will provide further guidance to both Fed and the broad direction of dollar and risk assets. One of the updates that have come in is that Bank of New Zealand has continued with its aggressive rate hike path, raising rates by 75 basis, lifting the official cash rate to 4.25%. JK, what are your thoughts? I would like to take the analogy of a cyclone. The eye of the cyclones are very calm. So, have we moved to the center of the storm, and is this calmness just a temporary lull?
Yes, I see the holiday period is obviously keeping the markets very quiet. I think participation has been very low also. So when you have uh, such a lull period, whereas data keeps flowing in, particularly from today onwards, the FOMC minutes and the PMIs, and then followed by PCE number and GDP data next week, I think we'll have definitely much volatile or even a trendy moment next week. So this is something that one should be prepared for, and maybe now it's time to sit back and analyze what the technicals are saying for the markets until we get more fundamental news. But we had some interesting fundamental news yesterday. The Paris-based OECD in their latest report projected India to be the second largest growing economy in FY 22-23, and even though the GDP forecast is lowered to 5.7% for FY 23-24, it would still be the fastest growing G20 nation. And more tellingly, they say that if global economy avoids a recession next year, it would be thanks mainly to the Asia's biggest economies such as India. So that's a very heartening to know that India is probably going to lead the global recovery next year. Being with India, the rupee obviously is, as we all see, settled into a narrow range, but definitely at a higher level of the dollar, facing resistance at 81.90. Some exporters selling and some inflows after being triggered by PSU bank selling has been seen, but unable to make much headway because of the many fundamental news that are in the pipeline, as well as the fact that oil prices have been very volatile. We do not know what direction it will take next. In fact, on the oil itself, the news about increase in production is still not totally out because the report, some reports indicate that the Saudis are not totally out of the realm of increasing production, mainly because two of the OPEC members, Iraq and UAE, want to pump more oil. And so in some way, I think OPEC may be waiting to see how the demand picture emerges after the oil price cap by G7 is implemented. On the economic front, there was much less data to digest. It was more of a second-tier data. And the data from Philadelphia non-manufacturing business sentiment report showed some improvement in the headline, but employment index, new orders, and wages trended lower, keeping the Dows happy. In fact, the other regional manufacturing data, which have been already released, suggest that further contraction in the sector, although the Empire State manufacturing only showed some improvement. On the European side, the eurozone consumer confidence rose by 3.6% in November from the October number. The Commission's flash estimate showed that it improved to minus 23.9 from a revised minus 27.5 in October. And the European Union as a whole, the sentiment rose by 2.8% to minus 25 points. So we are still in the minus territory, but definitely it is much improved. In fact, the distinction between European Union, just want to highlight, is that the European Union consists of those countries that meet certain membership and accession criteria, while eurozone is the subset of those countries which are actually using euro dollar as their national currency. But we have a lot of data going ahead, today, and most of the week's data have been crammed into the today because of the subsequent holidays. There's some pretty significant reports with October durable goods, weekly jobless claims, the preliminary number on S&P global PMIs, the revised November University of Michigan survey consumers, as well as the October new home sales. All of these are coming in the US session today. So we'll have some action on the US session before the traders there slip into the long weekend holiday. We'll also have S&P global PMIs for other major economies. Obviously, investors will be more keenly looking forward to the next week's calendar with US GDP, PCE core inflation, and the jobs report for November. And we in India will also look forward to the GDP of Q2 for India as well. Staying with Europe, the Bundesbank President Nagel opened the door on Tuesday to a smaller interest rate hike by European Central Bank, but said there was still a long way to go in raising the borrowing cost. Nagel has been one of those ECB hawks who generally favors higher rates, but told the reporters that 50 basis point increase would also be counting as strong, but added that rates were still too low to stimulate the economy and relatively far from restricting it. In Europe, 59 basis points of hike are priced in for December, unchanged from last week, and with a peak rate seen around 2.88% June next year. In fact, OECD is also saying that Europe should be raising rates much more to get a handle on the inflation. Staying with the markets, stocks were higher again yesterday. In fact, recovered some of the losses of the previous 2 days, more because of good news from corporates, particularly the retail side, which showed that consumers are not so much relenting in their purchases, and it's only going to improve as we get into the Thanksgiving weekend and also the Christmas period. So the outlook for some of those companies, as well as the improvement in the energy prices, has actually helped the stock prices overnight, with all the three major indices recording more than 1% rise, and some drift lower in the yields as well have helped the sentiment. Finally, let me end with one evolving story, or rather evolving talk in the market, that the new government in UK may be not ours to getting closer relationship with Europe, which has been cut off after the Brexit, and there are some private talks that by some officials in the government as well as in the Bank of England, which are indicating that UK has been hard hit by the post-Brexit. Their growth is expected to contract by 4% next year. And there is a lot of difficulty in companies getting talented, personnel for the jobs, and this has happened because of the restrictions that came about after the Brexit. Definitely, politically, this will not be talked about openly, but I think undercurrent is that there is something moving in that direction, perhaps not so fast, but definitely I feel that some amount of this news may be being factored into the current resilience of UK pound and the euro, but this is something that we need to watch out. Nothing concrete as of now. Thank you.
Thank you, JK, and some host of data which are basically keeping the doves happy as of now. And today we have got an action-packed data day with weekly jobless claims, PMI numbers, new home sales. Markets can be very volatile from next week as we get a lot more data with PC numbers being one of the major data points being released, as well as the GDP numbers. So keep managing your risk. That's it for today. We'll see you all tomorrow with the latest round of developments. Thank you so much for listening.